Inflation. It's one of those words we hear almost daily, on the news, in political debates, from central banks. Yet for most people, it's little more than a vague concept. Rising prices, shrinking purchasing power. That's about as far as the average understanding goes. But inflation is much more than rising prices. It's a slow, invisible thief. It doesn't just affect your grocery bill or your rent. It reaches into your wallet, your retirement savings, your investment portfolio, and pulls value out of them day after day. We're told inflation is normal, a sign of a growing economy, something we just have to live with. But here's the truth. Treating inflation as background noise is one of the biggest mistakes you can make as an investor. Because while you're focusing on returns, inflation is quietly reducing their value. And if you're not careful, it can destroy your financial progress before you even realize it. Let's make this real. Imagine you've worked hard and saved $100,000. You don't want to risk it in the market, so you leave it in cash. After all, it's safe. But if inflation averages just 4% per year, in 10 years that $100,000 has lost over 33% of its purchasing power. It can buy only 2/3 of what it could when you first saved it. And if inflation spikes to 7% or 8%, as we've seen recently, that erosion happens even faster. Now think globally. In 1920s Germany, inflation got so bad, people burned currency to stay warm. In modern-day Venezuela and Argentina, salaries become worthless within months. Even mild inflation in developed countries can quietly decimate wealth over time, especially for those who aren't invested intelligently. Let's break it down more analytically. If you earn 6% annually from your investments, but inflation is 7%, your real return is negative. You're effectively losing money, even if your account balance grows. That's the difference between nominal returns, the number you see on your screen, and real returns, which reflect your true purchasing power. Inflation is a hidden tax. It's not voted on. It doesn't show up on your bill, but it impacts every single dollar you hold. And the longer your investment horizon, the more damage it does if you don't adjust for it. Let's talk about bonds. Traditionally, bonds are considered the safe haven of investing. Reliable, low risk, ideal for retirees or conservative portfolios. But in an inflationary environment, that safety is an illusion. Bonds pay a fixed interest. So when inflation rises, the real return drops. A 2% bond yield in a 6% inflation, the world is a 4% guaranteed annual loss. Add taxes, and you're in worse shape. It's the equivalent of locking your money in a vault that leaks value every year. Now consider stocks. Equities tend to outperform inflation over the long term. But not all stocks are created equal. Companies with high debt loads, tight margins, or price-sensitive customers struggle during inflationary periods. Their costs rise, but they can't pass those costs on to customers, and profits fall. Investors then panic, driving prices down further. Only companies with strong pricing power, the ability to raise prices without losing customers, tend to outperform. Think of Coca-Cola, Apple, healthcare providers, utility firms. These companies offer essential products or have loyal customer bases. When prices rise, they adjust, and their margins hold steady or even improve. Let's not forget cash. Cash gives you flexibility, security, and the feeling of control. But during inflation, cash becomes the most dangerous asset of all. It quietly loses value every day. Keeping $50,000 in a savings account with 0.5% interest, while inflation is 6%, is like watching your future burn. Slowly, but surely. It's financial erosion disguised as caution. So, what's the solution? How do smart investors protect their wealth in an inflationary world? 1. Real assets you can touch. Real estate, farmland, infrastructure, commodities. These tend to rise in value as inflation pushes up the cost of physical goods and rents. Real estate offers a double benefit: asset appreciation and inflation-adjusted rental income. Commodities like oil, natural gas, wheat, and copper all see surges when prices spike globally. 2. Equities with pricing power. Seek companies that can pass cost increases onto customers without losing them. Consumer staples, healthcare, energy. These sectors tend to do well when inflation bites. Warren Buffett consistently invests in firms with strong pricing power for this reason. Because in inflationary times, pricing power is profit power. 3. Dividend growth stocks. Not just dividend payers, but companies that consistently raise their dividends year after year. Think Johnson & Johnson, Procter & Gamble, McDonald's. These dividends don't just generate income, they grow over time, helping offset the decline in purchasing power. It's like giving yourself a raise every year. 4. Inflation-protected bonds and alternatives. U.S. tips adjust their principal based on inflation. They won't make you rich, but they're reliable anchors in a storm. Gold has long served as an inflation hedge, though not always with perfect timing. Bitcoin is a newer player, more volatile, seen by some as digital gold. Used wisely, these assets balance the risk in traditional portfolios. 5. Cash flow generating assets. Rental income, digital products, royalties, licensing deals, content monetization. Anything that brings in consistent, inflation-adjusted income becomes more powerful as money loses value. When prices rise, cash flow is king. Finally, stay invested. The worst thing you can do is panic, sell off, and sit on the sidelines. Timing the market rarely works. Inflation isn't a reason to run, it's a reason to reposition. Real wealth is built through consistency and adaptation, not reaction. Now let's talk mindset. Inflation isn't temporary. Even when it cools down statistically, its effects linger. The lost value doesn't come back. That's why acting early is critical. The average person ignores inflation until they see prices spike. The smart investor anticipates it, hedges for it, and builds a portfolio designed to thrive through it. So here's your challenge. Audit your portfolio. How much of it is vulnerable to inflation? How much is truly protected? Where's your pricing power? Where's your cash flow? Where's your real asset exposure? This video gave you a wake-up call. Give it a like. Share it with someone who's still hoarding cash in a savings account. Drop a comment below. What are you doing to beat inflation right now? Let's share ideas and sharpen each other. And if you want to stay ahead of the financial curve, subscribe to the channel. Join the foxhole. This is Old Fox Finance, and we don't fear inflation. We outsmart it. Stay sharp, stay invested, stay ahead.